Hello and good morning, everyone. Thank you for joining us today. My name is Marissa Streckfus. I am Vice President and Claims Manager for RT ProExec and located in Bloomfield, Connecticut. I would like to welcome you to this webinar brought to you by RT ProExec, the Management Liability Division of RT Specialty. In our webinar today, we are going to be discussing key developments during 2025 in the Directors and Officers Liability and Insurance arena. Next slide, please. We are fortunate to have with us this morning my colleagues, Kevin LaCroix and Chris Bertola. Kevin is an Executive Vice President of RT ProExec in our Ohio office. Kevin has been involved with D&O liability issues for over 40 years. He is also the author of the D&O Diary. Chris Bertola is a Senior Vice President with RT and is located in our Bloomfield, Connecticut office. Chris is one of the co-heads of our group's private company management liability team. Chris has been involved in D&O for over 15 years. Next slide, please. Before we get started today, just a few words about Ryan Specialty. Ryan Specialty is a leading international specialty insurance firm that offers wholesale brokerage services, delegated underwriting expertise in the form of binding authorities, 20-plus national programs, and over 30 highly specialized managing general underwriters. Ryan Specialty shares are listed on the New York Stock Exchange and trade under the ticker symbol RYAN. Next slide, please. Most of you on today's call may know about RT Specialty's practice group for professional and executive liability lines, but some of you may not know that RT actually has 20 specialty practice groups. For further information about RT's practice groups, please visit the RT website at www.rtspecialty.com or just contact any one of the three of us after the webinar. Before I turn it over to Kevin, just a few housekeeping pointers. Audience members can ask questions using the Q&A function in our Zoom webinar. Chris will be screening the questions and will pass along as many of them as he can during the course of the webinar. We will do our best to answer your questions as they come in, but if for any reason we're unable to get to them, please feel free to contact Kevin, Chris, or me after the webinar at any time. Copies of today's slides from today's webinar and a link to the recording of today's session will be made available via email to all registrants within a day or two after the completion of today's session. We are also interested in your thoughts about this webinar. We would be very grateful if after this session, you could drop one of us a note to let us know your thoughts about today's session. The final slide has our email addresses. And with that, I am now going to turn this over to Kevin to lead our discussion. Kevin, please take it away.
Thanks, Marissa, and good morning, everyone, and good afternoon to our friends that have dialed in from Europe and the UK. Welcome to this year's installment of the Top 10 Stories in D&O. Past experience from prior webinars tells us that although we are all teed up to do all 10 stories this morning, the likelihood is we won't get to all 10 in the 60 minutes allotted. Those interested in the stories we don't get to today should refer to my top 10 blog post, which I published on my blog last week on January 6th. And as Marissa said, we will be making the full set of slides from today's program available to all attendees. Before we get started, there are a couple of things you may want to be listening for in my presentation. First, I suggest you may want to listen to how many times do I mention the False Claims Act? And second, how often do I mention federalism issues? With that, let's start with this year's first topic, which has to do with the annual volume of federal court securities class action lawsuits. D&O insurers closely track the number of securities class action lawsuit filings because the number of annual filings can provide some indication of the insurer's ultimate loss costs during the year, and the current year's filing patterns can inform insurers' efforts to try and determine the profit-making price for their D&O insurance products. The statistics show that during 2025, the number of securities class action lawsuits filings declined slightly after 2 years of increases, to the lowest level since 2022. There were 17 fewer federal court securities class action lawsuits in 2025 compared to 2024, representing a decline of about 7%. Please note that these figures reflect only federal court securities class action lawsuit filings. They do not include state court securities class action lawsuit filings. For those of you who may not be familiar with the information in the slide, I want to point out something that potentially could be distracting and even perhaps misleading. I know a lot of people looking at the slide are going to look at the enormous upsurge during the 5-year period 2016 to 2020 and compare those years to the following years and think there's been some kind of huge drop off. The 2016 to 2020 years were distorted by a short-term phenomenon. The run-up during those years represents the filing of federal court merger objection lawsuits. Because those cases were filed as class actions and because they allege violation of securities laws, they counted, and so they show up in this slide. These kind of lawsuits are still being filed, but for tactical reasons, the plaintiffs' lawyers aren't filing them as class action lawsuits, and so they don't show up in the class action statistics. For purposes of thinking about the volume of securities litigation in 2025, it's better to reference the last 5 years than the 2016 to 2020 timeframe. Next slide, please. A couple of things drove the filings that did arise during 2026, and two of those things were ongoing themes or patterns. There were, for example, 14 securities class action lawsuits involving artificial intelligence related allegations, and I'm going to be talking about those separately in the next topic. There were also 8 securities suits involving cryptocurrency related allegations. So those two categories together represent about 11% of all the filings. There were other trend or theme related lawsuits. If you can go to the next slide, please. But they presented themselves differently in 2025 than perhaps in prior recent years. This slide shows 2 of those themes, COVID-related lawsuits and SPAC-related lawsuits, and it breaks those kind of lawsuits down between the 2024 and 2025 years. And you can see that with respect to both of these categories of lawsuits, the number of those kinds of lawsuits filed in 2025 dropped compared to 2024. You can see there were 13 fewer COVID-related lawsuits, and in fact, there were none at all after April 2025. And there were 4 fewer SPAC-related lawsuits, and none at all after July 2025. Those 2 categories alone accounted for a drop of 17 lawsuits, which of course was the difference between 2025 and 2024. So in a sense, you could say that the drop off in 2025 was as a result of the declining influence of these trends. Could you turn to the next slide, please? In thinking about who was getting sued, it's pretty apparent there were 2 key categories. The first category is an industry group involving biotech, pharma, and medical devices. And you can see that in 2025, companies in those categories were sued in almost 25% or a quarter of all of the securities class action lawsuit filings. Computing high-tech software companies represented 30 of the lawsuits, or about 15%, and those 2 categories together about 39%, or 4 out of every 10 lawsuits. So those 2 industry groups obviously were key factors. I'm going to stop there, Marissa, and see if you have any questions about the securities class action filing data.
Yes, thanks, Kevin. So I'm very interested in those observations about the amount of litigation involving those biotech and high-tech companies. From your perspective, is the kind of frequency for those industry groups unusual or unexpected in any way?
No, in fact, we pretty much see that every year. There is a SIC code within biotech, 2834, which is most biotechs are in that category. And that's always the SIC code that has the most security suits. And I think if you ran this same analysis for the past 20 plus years, you would see a pattern that looks pretty similar to this. I ran a D&O underwriting facility from 1995 to 2005, and it was the same pattern then. I think it's just a reflection of the kind of companies that are in those categories. If you think about it, many of them have new products or new services. They're untested. They may trade on speculation for the possibility of future profits. And if they hit an impediment, whether it's a regulatory disappointment or a problem with their product, their share price declines significantly, and they track the securities lawsuit. So it's really almost more having to do with the volatility of the share price of companies in those categories that explains why they have such a high frequency. Any other questions, Marissa?
Yeah, thanks, Kevin. I do have one more. So I know, and we've spoken in years past, that you track securities suits that are filed against non-US based companies. So in 2025, what was the level of security suit filing involving those non-US based companies?
Well, you're right. And every year there are a significant number of suits against non-US companies whose shares are listed on the US exchanges. And just to be clear, when I refer to non-US companies, I'm talking about companies either that are organized under the laws of another country or that have the principal place of business in another country. And by my count, there were 33 such lawsuits in 2025. So 33 out of 205, or roughly 16% of the securities lawsuits. That 16% is interesting because well over 20% of the companies traded on the US exchanges are non-US companies. So the frequency against those companies is actually less than you might expect, given their prevalence on the exchanges. And that might come as a little bit of surprise to some of the people listening, but those companies aren't getting sued because they're in another country. The three companies from Ireland that got sued weren't sued because they're Irish. They got sued almost certainly because they were biotech or high-tech companies. Similarly, the three companies from Israel that were sued last year were sued because they were high-tech companies. And it to try and think about analytically of those foreign companies as somehow separate from an underwriting risk standpoint, you might overlook the more important point that it's a much more important factor what industry they're in, that will tell you more about the likelihood they will be hit with a suit than the fact that they're based in another country. So I'm going to pause there. Chris, do we have any questions coming through on the Q&A line?
No questions at this time, Kevin.
Okay, just a reminder, everyone, you have an opportunity to use that Q&A function to pose your questions. So please feel free to pose those questions as we go along. Can we go to the next slide, please? When I was talking about the securities class action frequency, I emphasized the prevalence of new lawsuits involving allegations concerning artificial intelligence. And it's been a factor in securities litigation for several years. If we can go to the next slide, please. As we've been tracking these cases as they come in, they've really fallen into two categories. Categories that involve what have been referred to as AI washing type allegations. That is, allegations that the company overstated either its prospects or capabilities. And then AI risk related security suits, allegations the company understated the risk that AI adoption poses for the company. And I'm going to talk about each of those two categories separately. First, referring to the AI washing cases. If we can go to the next slide, please. I have here two examples of companies that were sued in 2025 on AI washing type allegations. And again, AI washing allegations are allegations the company overstated either its prospects or capabilities. And the first of this is a company called AppLovin, which is a digital ad platform which touted its cutting edge AI technologies, which was supposedly being used to match ads to gaming users. There was a short seller report alleging the company had overstated its AI capabilities. In fact, was using manipulative technologies to inflate its supposed ad click-throughs rather than using AI technology to drive its app click-throughs. When that short seller report came out, the company's share price declined and a securities class action lawsuit was filed. Tempus AI is a company that it is in the healthcare space, and its product is to use AI for diagnostic and testing analysis purposes. And there was, again, a short seller report that alleged that the company had overstated its AI capabilities, and in fact, most of its revenue was based on its use of non-AI based tools. And when that short seller report came in, the company's share price declined and securities class action came in. And I would say over the time since we started seeing AI related lawsuits a few years ago, most of the lawsuits have been AI washing type cases. But there's this second category. If we could go to the next slide, please. The second category is companies that rather than overstating their AI capabilities or prospects, they understated the risks. And I have three examples here: Reddit, Synopsys, and Double Verify. Reddit was sued after it lost ad revenue after Google changed its search results using AI-generated results rather than links to websites, which resulted in a decline in traffic to Reddit's website. Synopsys is a technology company that provides specific design properties for use in hardware, and it shifted its focus to AI-related businesses. But the allegation is that it omitted to disclose that this would drive up their operating costs because the design requirements for the AI-driven tools required increasing customization, resulting in an increase in their operating costs and decline in their profitability. Double Verify is a company that runs ad tracking technology, and the allegation was that it had omitted to disclose the extent to which its technology could not differentiate between human-generated traffic and bad actor traffic. All three of these cases are interesting to me. If we can turn to the next slide. What's interesting about these cases is that in each case, it wasn't the company's own adoption of AI that caused the problem. It was, in Reddit's case, it was Google's adoption of AI. In Synopsys' case, it was customers' adoption of AI. And in DoubleClick, it was the third-party bad actors. And I want to emphasize that for those of you who are on the underwriting side and are tasked with thinking about how to underwrite for AI-related risks. And the concern I have here and the challenge, the underwriting challenge is, again, it wasn't the company's own adoption of AI that caused the company problems. So when thinking about operating problems that companies can have, and it isn't going to be enough to ask how the company itself is using AI technology. It will also, the assessment of the risk will also involve considering the risks of the company from adoption of AI by competitors, customers, suppliers, regulators, even third-party bad actors. And I think that creates a particular challenge from an underwriting standpoint. But if I had to predict, if we were to gather 2 or 3 years from now and talk about AI-related litigation, I'm going to go out on a limb here and suggest that we're going to see more of this AI risk-related litigation, more so than the AI washing type litigation. There's another category. I don't actually have a slide for this because it's so new developing that I really hadn't started evolving a theory on it until recently. And that has to do with companies that aren't just businesses that are in, say, manufacturing or transportation or logistics or something like that, but that are AI companies. Their business is AI, like AI logistics companies. And I think that may represent an entirely different category of risk. I'm going to refer to 2 recently filed cases, one called Fermi and another called CoreWeave, both of them whom have been sued in securities class action lawsuits just in the first weeks of 2026. And if I were to use my standard framework, I would have to say each of those 2 new lawsuits involved both AI washing type allegations and AI risk type allegations. So they kind of straddle those 2 categories. But overall, I think we're talking about something completely different when we're talking about an AI-based company, that it's its own category of risk, because everything about the company's operation and financial results have to do with AI-related risks, and they're subject to any number of pressure points that could cause the company's share price to decline. So if I were to conjecture, I would say, as the year evolves, there probably will be a third category emerging, which is companies in the AI industry, one way or another, who have their own unique set of risks. I emphasize that because I think this is one that is just now emerging. Can we turn to the next slide, please? When we're thinking about AI in 2026, there are 2 things in particular I want to be sure that we're all focused on. And again, I think these are both important from an underwriting standpoint. The first has to do with AI-related regulation. If you could turn to the next slide, please. Regulators around the world are focusing on prospective or actual AI regulation or legislation. And that's at the state, national, and international level. And there are reasons why regulators are worried. Issues such as bias in employment, healthcare, or school admissions, the use of deep fakes, exposures to children from language-based models, intellectual property issues, privacy issues. And that has encouraged legislatures and regulators around the world to consider possible regulation. And within the US, we have some federalism issues that are emerging. Several states, including California, New York, and others, have passed or are considering either AI regulation or legislation. At the same time, in December, the White House issued an executive order titled Ensuring a National Policy Framework for Artificial Intelligence. And the executive order seeks to override or preempt state law on AI in favor of unified federal regulation. Critically, the executive order creates an AI litigation task force for the purpose of filing lawsuits to challenge state laws inconsistent with the executive order. So I think we can all put under our calendars for 2026 a looming federalism fight. The one thing I will predict, nothing about the executive order is going to stop state legislatures from looking at these issues. And in fact, even just in the short time since the executive order came out, several states have either initiated or passed legislation on AI issues. So I think we can all calendar for 2026 a looming federalism dispute over AI regulation. If we can go to the next slide, please. There's one other critical AI wildcard for 2026, and that has to do with what many observers have called an AI investment bubble. And there are a lot of factoids that you could point to as support for the theory that there is a bubble. The first bullet point here cites statistics from Goldman Sachs that there are over 1,500 ventures in the US valued at over 100 million. And I should add to that, they are startup AI ventures. So over 1,500 startup AI ventures valued at over 100 million. Just the big four, Meta, Alphabet, Microsoft, and NVIDIA, committed in 2025 alone to over 400 billion in artificial intelligence capital expenditure. And then this is a statistic from Bloomberg that of the top 38 AI-centric stocks, only about 8% of the 500 companies, they represent only about 8% of the S&P 500 companies, but they together represent nearly 50% of the index's total market capitalization. Industry leaders, including AI execs such as the head of ChatGPT and Microsoft, have warned about the existence of an AI bubble. And we all know that eventually investors are going to expect to see returns for their AI investments. So will the AI investors ultimately lose confidence? And if the bubble bursts, how will it affect the wider market? My crystal ball is no better than anyone else's, and I'm not making any predictions. Certainly my 401k is very happy right now, so I would be very happy if there isn't an AI bubble burst. But if there were to be one, this obviously could have a significant impact on financial marketplaces, and I think to the volume of AI-related D&O litigation as well. I'm going to pause there, Marissa. Any questions from you about AI?
Yeah, Kevin. So I thought your comments about underwriting considerations were particularly fascinating. And, in your discussion on the kinds and level of corporate and securities litigation with AI-related allegations with risk or washing and the like, do you think that there's D&O insurance terms or conditions companies should be looking for in anticipation of those types of claims or other claims that we might be seeing this year?
This is actually a question I get a lot, Marissa, and from a lot of different kinds of people. I get it from academics and from journalists. I get it from clients and retail agents that we work with. And the thing that I have to say in response to the concern is so far, the AI type claims that we've seen have been garden variety claims. They may involve AI allegations, but the claims themselves are very similar to the claims that we've always had and that the D&O policy has always responded to. So I don't know that there really is much of a conversation to be had about how do we need to revise the policy to anticipate AI risk. I will say that another question I often get is, are D&O insurers or other insurers going to try and exclude AI-related risk? And I have heard scuttlebutt from certain quarters about that kind of thing. I did a survey of my team this week, and none of them reported seeing anything. That doesn't mean they're not out there. I mean, we just might not be seeing it. I will say I don't have much expectation to see AI exclusions in this phase of the market cycle. We're in a soft phase of the cycle, and I think it would be very uncompetitive at this point to try and stick on an AI exclusion. I think that all would happen is that the insurer that tried to do that would lose the business because there are plenty of other carriers that would be happy to write the business without the exclusion. Now, on all these points, I say stay tuned. If the AI bubble bursts and there's a huge volume of AI-related litigation, or there's a whole new category of kinds of AI-related claims, you could definitely see some claims. But for now, I'm not seeing that. So a little bit of change of direction now. Chris, any questions showing up on the Q&A box so far?
Yes, Kevin. One question that came up is, how should public companies be working with their counsel to evolve disclosures in light of these cases?
It's a great question, and the cheap and easy out for me to say that I'm not a lawyer and they should consult with outside counsel. But I won't take that easy dodge, and I will say, especially with respect to the category of risk that I mentioned, I think it has to start with reconceiving what AI risk consists of. And it may be easy to see that the risks to the company from its own AI adoption, and perhaps it's easy for it to see what its competitors' AI adoption might do to its business prospects. But to really walk all the way around the risk environment that involves the movement towards AI, you need to think about customers, regulators, third-party actors. And so I think it may be quite an involved exercise in reimagining corporate risk in order to make sure that you've got risk disclosure that both adequately informs investors, but also provides the sort of protection that you would want to be able to have available in the event of a securities lawsuit. It's actually a big topic and probably one that would be worthy of a seminar in its own right. I think a lot of companies are feeling their way. And if you read disclosures in a lot of mainstream companies, it's pretty clear that there's no sort of standard AI disclosure that's yet developed. And I think that, like so many of the things we're talking about, AI related is going to be an evolving kind of thing, but clearly keyed to the D&O risk. Any other questions, Chris?
That's it for now. Thanks, Kevin.
Okay, great. Well, with that, then let's shift to the next topic and go to the next slide. One of the things I've spent a lot of the last year talking about are the policies of the Trump administration and how they may or may not affect D&O risk. And that probably also would be a fruitful topic for its own seminar, because there are many ways that the policies of the Trump administration have affected the world of D&O risk. I'm going to focus on one area, and that has to do with the Trump administration's tariff policies. And my goal here is not to talk about the policies in terms of whether they're good or bad policies or how they're going to affect global trade. It's really to think about how the tariff policies creates D&O risk. And for that, let's move to the next slide. There are really two ways that I can see that the tariff policies can present a D&O claims risk. And first has to do with regulatory enforcement, that is the Trump administration's enforcement of the tariffs that have been levied. And the separate is private civil litigation. I'm going to treat each of those two topics separately. If we can go to the next slide. The tariff evasion, which is what the regulation and regulatory enforcement would be concerned about, involves one of two types of problems from the administration standpoint. And that would either be misrepresentation of the country of origin or misrepresentation of the valuation. What those might be, say, a importer imports furniture from China and transships the goods to Malaysia before shipping to the United States and tries to present them as Malaysian products rather than Chinese products. And I cite that claims example because that actually is the basis of a regulatory enforcement action brought by the Trump administration. Similarly, you could change the category of the goods involved. If you change the category from solid wood to wood veneer, the valuations would be much lower. And I cite that example because that also is an example from an actual enforcement action brought by the Trump administration. The way the Trump administration brings these type of regulatory enforcement claims is one of two ways, either under the False Claims Act, and what's known as a negative False Claims Act claim. Typically a False Claims Act claim would be obtaining funding from the federal government under false pretenses. This would be failing to pay money owing to the federal government under false pretenses. And there have already been several examples of that. And you can refer to my blog for numerous examples that I've written about. There have also been examples where the Trump administration has brought tax evasion, criminal tax evasion charges. And in fact, there has been one example in recent months where the company was hit both with a False Claims Act claim and a criminal tax evasion claim. We can expect to see much more of this kind of activity. During 2025, the Trump administration announced two tariff enforcement priority movements. The first was the Department of Justice's May 2025 announcement that it will prioritize trade and customs fraud, including tariff evasion. So that is going to be an enforcement priority of the Department of Justice. And then in August, the Department of Justice announced the formation of a cross-agency task force with the Department of Homeland Security to ensure robust enforcement against importers and other parties who seek to defraud the United States. So you could put it on your agenda for 2025. There's going to be more tariff enforcement action in 2026. If we can go to the next slide. It might be harder to envision how the tariff policies can translate into civil litigation, but I have two examples here, both of them being securities class action lawsuits. I want to pause there for a moment. Even these two examples of securities class action lawsuits, and therefore likely to be of concern more to publicly traded companies rather than private companies, I want to emphasize that a lot of these problems are problems both for private and public companies, especially the enforcement actions that I talked about on the prior slide. All of the examples that I was referring to that I've cited on my blog are private companies. So this is not a risk area that it's limited just to public companies. It includes also private companies. And I wanted to point that out, even though these are two securities class action lawsuits, this is a risk category that involves both private and public companies. So the first example is Dow, which is an industrial chemical company located in Michigan. Industrial chemicals, sort of the heartland of America type products. When the tariffs were announced in April, it said that it was well positioned to deal with the tariffs and reaffirmed its commitment to its generous dividend. But in the very first quarter after that reassuring statement, the company announced disappointing financial results due to macro factors, including the tariffs, and of greater interest to the investors, they cut their dividend. And as a result, their share price declined and the securities class action lawsuit came in. The other example is a company called CarMax. Many of you are probably familiar with it. It's a nationwide retail used car business. And the plaintiff's allegation is when the company experienced a sales increase after the tariffs were announced, the company portrayed that increase in revenue as due to competitive advantages the company enjoyed in the marketplace. And instead, time has proven that it was a temporary run-up in sales as people were front-running the tariffs before they went into effect. And after the tariffs went into effect, the company's sales fell, its share price dropped, and the securities lawsuit came in. Both of these cases involving misrepresentations relating to tariffs have been described by one commentator as tariff washing. I just wanted to be sure to refer to that just in case those of you listening out there hear that reference. that reference to the that term. I'm going to pause there and Marissa, see if you have any questions.
Yeah, Kevin. So, thanks again for your comments on this particular topic too on tariffs. So we know that this is before the Supreme Court, this particular issue on tariffs, and some of the companies involved have already paid those tariffs. So if the Supreme Court rules against the Trump administration in that case, what happens to those amounts that have been paid?
Well, that's a great question. In fact, you anticipated my next slide. In fact, on my next slide, I talk about the pending securities court case. So if we can go to the next slide, please. You're right, Marissa. There is a case pending in the United States Supreme Court, Learning Resources versus Trump. Learning Resources is a toy manufacturer. Most of its toys are manufactured in China. It basically felt that it had no choice other than trying to resist the tariffs because it would quickly go out of business if its business model was undercut that much. So the specifics of the allegation is that the allegation is the Trump administration exceeded its authority under the International Emergency Economic Powers Act, the IEEPA, and the Constitution by imposing tariffs. The allegation is that the tariffs are reserved in the Constitution for Congress, and they are not permissible regulation within the meaning of the IEEPA. So the tariffs represent a violation of the separation of powers and a violation of non-delegation principles. The case was heard in, the oral argument in the case was heard in November 2025. Decision is expected any day now. And I wouldn't be surprised if, in fact, there's a ruling this week. A couple of things about that before I get to your question about what happens to the tariffs that have already been paid. If we can go to the next slide. The next slide makes a point that I think everyone needs to be very aware of. The Trump administration could lose the Learning Resources case. I mean, notwithstanding the conservative cast of the court, the case does raise very serious separation of power issues. So if the Trump administration loses, that does not mean the end of tariffs. For starters, some of the existing tariffs were not levied in reliance on the IEEPA. Some of them were levied in reliance of other statutory authority. For example, the tariffs on steel and aluminum were based on other statutory authority. And there are alternative pathways the Trump administration could use. They're less attractive because either they're time limited or require subsequent affirmance from Congress. And that's why the Trump administration didn't use them in the first place. But I don't expect tariffs to go away, even if the Learning Resources cases goes against the Trump administration. I think the Trump administration will continue to use the tariffs as one of its main tools in trade policy and even foreign diplomacy. So now to get to your question, Marissa, what happens if the Trump administrations, there have been tens of billions of dollars, if not over $100 billion in tariffs paid? Well, tariffs are taxes, and anytime anyone feels they've overpaid a tax, they can seek a refund. And in fact, I saw this week on Bloomberg that over 1,000 companies have already filed with the Court of International Trade petitions for refunds of tariffs. So be prepared for a flurry of tax refund activity. Will have a significant impact on the federal government's tax revenues because tax collections that have been accumulating based on the tariffs could reverse. So stay tuned for that. Something to watch for. But I think the key thing is for the folks on this audience listening and worrying about D&O risk from the tariffs. I don't think it's going away, even if the Trump administration loses at the Supreme Court. I'm going to pause there. Chris, any questions from the audience?
Not at this time, Kevin.
Great. Thank you. Let's go on to the next topic then. If we can move to the next slide. Thank you. So one of the great things about being president is you get to make a lot of nominations, and those nominations, I think we all recognize, are impactful, and we can see that certainly in defense and healthcare and many other departments. It's also been true with respect to the SEC, where the Trump administration's nominee as the chair of the SEC is Paul Atkins. And it's only been a few months since Mr. Atkins has taken his position, but it's clear there have already been a host of changes. If we can go to the next slide, please. So probably the biggest and most practical is the SEC is a lot smaller than it was under the prior administration. The SEC has reduced its headcount on purpose through buyouts and reductions in force. And the impact has been most pronounced with respect to the enforcement division. If you think about who's likeliest to take a buyout, it's somebody near the end of their career, meaning that many of the people who have left the SEC are among the most experienced regulators, participants, members of the SEC staff. And that has resulted, it appears, in a reduction in enforcement activity. Enforcement activity through the end of the fiscal year, which ended September 30, was down. Standalone enforcement actions were down 27%, and enforcement actions against public companies were down 30%. And if you break those public company enforcement actions down between enforcement actions filed before the advent of the Trump administration and after the advent of the Trump administration, the statistics are even more extreme. In the second to last bullet point there, of the 56 fiscal year 2025 enforcement actions filed against public companies, only 4 were filed under the Trump administration. All of the others were filed under the Biden administration. Now, in thinking about the significance of that statistic, you may want to keep in mind that the new head of the enforcement division, Margaret Ryan, didn't assume her office until September 2025. So what you can speculate that perhaps that had some impact on the fiscal year statistics. But keep in mind that there have already been several months of experience since the end of the fiscal year, and there is as yet no greater pickup in public company enforcement activity. I saw a comment earlier this week by a former SEC senior executive who commented that he wondered whether the enforcement division has gone out of business. And I think that's a bit extreme, and I'll get back to my reasons why I think that. But if you turn to the next slide, please. There have been a host of other changes, and some of them have been pro-enforcement that bespeak the likely future enforcement activities, such as, for example, the administration's creation of a cross-border task force to protect U.S. investors from cross-border fraud. But there have been a host of other actions taken by the SEC to unwind an approach that Paul Atkins has characterized as regulation by enforcement. And by that he means the administration, the prior administration, was setting policy not by issuing regulations or declaring policy, but by pursuing enforcement actions that communicated to the financial marketplace what the administration's position was on certain issues. And so there was, for example, a significant amount of SEC enforcement activity against crypto companies, and much of that pending cryptocurrency-related enforcement activity has been dismissed under the Trump administration. Similarly, with respect to ESG issues, the defense that the SEC had been mounting in the challenge, the judicial challenge to the climate change disclosure guidelines, the SEC has advised the Eighth Circuit that it is withdrawing its defense of the guidelines, meaning that it will no longer defend the guidelines, and putting the Eighth Circuit case in a very strange kind of limbo because there's no longer really an adversarial proceeding. But at a minimum, it means that the Trump administration, or the SEC under the Trump administration, is stepping away from the prior administration's ESG approach. And similarly, with respect to cybersecurity disclosure, the agency has dismissed the remaining allegations pending in the enforcement action, the cybersecurity disclosure enforcement action brought against SolarWinds. If we can go to the next slide, please. There have been a host of other policy changes. In fact, there's been really a whirlwind of activity. And I summarized just some of them here, showing the changes in direction that have been initiated under Paul Atkins at the SEC. The first one, referring to the elimination of quarterly reporting, was proposed in the third quarter, and it remains to be seen whether that will happen. I note that earlier this week that the Paul Atkins issued a statement that he's going to re-examine all of Regulation SK, which regulates all periodic disclosure by public reporting companies. So the entire structure of public company reporting, at least theoretically, could be in play. I don't expect there to be the elimination of quarterly reporting, or at least regular periodic reporting, but there could be significant changes. We've also seen the SEC change its policy regarding prospective IPO companies that have mandatory arbitration bylaws. In the past, the SEC has refused to accelerate the registration of IPO applicants who have such bylaws, and that's very negative for the prospects of the offering, because it makes it difficult for the offering underwriters to ensure that the offering happens on a specific day. So by allowing the application to be accelerated, it means that companies that have mandatory arbitration bylaws can get accelerated registration and conduct their IPO on the schedule they want. So we can expect to see the possibility of more IPO companies with mandatory arbitration bylaws. Other changes have to do with Wells notices, proxy statements, and Chairman Atkins has even said that he wants to try to revitalize the markets in ways that will help eliminate frivolous complaints. If we can turn to the next slide, please. The question is, does this mean that the SEC is no longer the cop on the beat? And I think it would be a big mistake to assume that. I think there will be enforcement activity. It may differ in kind and in volume from the activity by the SEC under the Biden administration, but there will be SEC enforcement activity. So it would be a mistake to assume that the cop is no longer on the beat. Chair Atkins has indicated he intends to focus on quality rather than quantity, and what he calls a back to basics approach with a focus on core issues such as insider trading or accounting fraud, with an emphasis on investor protection and a goal to making capital formation less burdensome for companies. So any questions there, Marissa, about the changes at the SEC?
Yes, Kevin, I know it's been, a pretty big change since the last administration, but while you're of the mind that the enforcement is not going out of business, what do you think that the SEC's differing approach on regulation and enforcement is going to have on private securities class action litigation going forward?
It's an interesting question, and the short answer is I don't really know, but I do know certain things that are relevant to answering the question. The first is, in the past, there has been an important relationship between SEC enforcement action and private civil litigation. And I think most informed observers know that private civil lawsuits that have a parallel SEC enforcement action usually are much more dangerous. So it's at a minimum a marker of merits for the private civil litigation. There is certainly a long track record of private civil litigation following SEC enforcement action. So if there are fewer SEC enforcement action, will that mean fewer private civil lawsuits? I don't know. It certainly will be interesting to watch. I certainly am not going to predict that, and I think it would be a mistake for anybody to act on the assumption that that's going to be so, but it definitely will be something worth watching. Chris, any questions from the audience?
Not at this time, Kevin.
Great, thanks, Chris. With that, let's move to the next slide and talk about cybersecurity. Cybersecurity, I think everyone on this call knows, is a perennial issue. It's one we've been talking about at least for the last decade. And I think we all know there has been cybersecurity related D&O litigation in the past. And my observation is much of that litigation has been a mixed bag for the plaintiffs lawyers. There have been some successes, but many of the high-profile cases have been dismissed as well. If we can go to the next slide. The interesting thing to me is that the plaintiffs' lawyers continue to file cybersecurity-related lawsuits, and there were two filed just in December, two securities class action lawsuits. The first, Coupang, a securities class action lawsuit relating to the largest data breach in South Korean history. And the allegation is the claimant alleges that the company misrepresented the quality of its security and systems controls. And then also in December, F5, which is a cybersecurity hardware company, it turns out it was the subject of a long-term nation-state actor intrusion on the company's systems. And the plaintiffs allege that the company made misleading statements about the true state of the company's securities capabilities and about its ability to secure data for its clients. Both cases representing cybersecurity cases, I think both of them also representing signs to those of us in the D&O community that there will continue to be these kind of cybersecurity related claims. If you can go to the next slide, please. The interesting question is, what will the Trump administration's approach to cybersecurity be? And on that, the message is kind of mixed. In February, the Trump administration announced, the SEC announced the formation of a cyber and emerging technology unit, although to date, the SEC has not yet initiated any cyber-related enforcement actions. In July, the Department of Justice, together with Illumina, entered a $9.8 million settlement in a False Claims Act claim, yet another False Claims Act claim, underscoring the fact the False Claims Act really is the Trump administration's enforcement tool of choice. And in this case, the company was alleged to have sold genomic sequencing systems with cybersecurity vulnerabilities to the federal government in violation of the False Claims Act because it received revenues based on the representation about its products. I already mentioned that in November, the SEC dismissed the remaining allegations against SolarWind. The wild card for me is what the Trump administration will do with respect to the Biden era cybersecurity disclosure guidelines. There have been observers and commentators that have called for the SEC to withdraw those guidelines. It has not yet taken any action. So I would say I put that on your agenda of likely areas where we could see regulatory activity in 2026. So stay tuned on that. But to this point, there's not enough from which to generalize about the Trump administration's approach to cybersecurity. Any questions, Marissa?
Yes, Kevin, thank you. So I wanted to ask a question about the cybersecurity related security suits from 2025. Given that this is an issue that is perennial for firms, I was wondering why there weren't more of these suits filed. Like, do you have any theories on why there wasn't more cybersecurity related securities litigation? Do you think the plaintiffs' bar has changed tactics or gotten wise in any way? I was interested in your thoughts on that.
Yeah, it's an interesting question. I mean, if I were honest, if I rolled back the clock 10 years, I was among the observers and commentators suggesting that we would see cybersecurity-related D&O claims in volume. And it has not materialized as I anticipated and others anticipated. And I think the main reason is, I think the financial markets have gotten inured to news of a cybersecurity breach. If you look at what happens these days when a company announces that it has been hacked or had an intruder, most of the time the company's share price doesn't decline. And so there's little in that set of circumstances to attract the interest of the plaintiff's lawyers. I think we will still see some cases filed, as those two cases filed in December show. It just won't be the volume that I think some of us anticipated. Again, there's sort of a wild card on what the Trump administration is going to do from a regulatory standpoint. But I think in the grand scheme of things, cybersecurity has turned out to be a different kind of D&O risk than many of us anticipated. Any questions from the audience from your end, Chris?
Nope, good to proceed, Kevin.
Great, thank you. In the interest of time, I'm going to touch on the next topic. We can go to the next slide, please. I'm going to talk about it relatively quickly, and that has to do with the Trump administration's approach to ESG issues, environmental, social, and governance issues. If you turn to the next slide, the Trump administration has been most active in this area with respect to its anti-DEI efforts. That is the S pillar in the ESG pantheon. And that's a separate topic, which I dealt with separately in my top 10 blog post and is set up separately in this slide presentation. I don't think we'll get to it this morning, but the slides will be there. But with respect to climate change issues, I think it's important to know that the Trump administration has issued a series of executive orders that touch on climate change related issues. Probably the most telling of which is the last one listed here, the executive order captioned "Protecting American Energy from State Overreach." Clearly, the Trump administration is key to protecting companies in the hydrocarbon industry, potentially raising yet another federalism issue. If we can go to the next slide, please. I want to emphasize that while the Trump administration has taken these positions on climate change related policies, those are political and legal issues, and the underlying circumstances don't change. And I think all of us in the D&O risk business, particularly those of us who plan on being around 5 and 10 years from now, need to focus on the fact that companies today still need to be coming up with a long-term plan of how they're going to manage their operations and finances in light of changing operating circumstances. And more importantly, that the decision corporate boards make today or fail to make today will be subjected to scrutiny in the future. And future claimants in the D&O claims that we will be seeing 5 or 10 years from now will be asking about the decisions that boards and management made to address operational issues such as redundancy, durability, and resiliency. So I think it's a long-term D&O underwriting issue. There's no doubt that from a short-term underwriting standpoint, ESG is a very different issue than it was 18 or 24 months ago. But that doesn't mean the issue has gone away. In the interest of time, I'm going to ask to slip to the final topic, which is the state of the D&O insurance marketplace. So, Jens-Ol, if you could flip ahead to the final topic, and I will cover that. I will go ahead and get started while Jens-Ol's flipping ahead. I think everyone listening understands that, next slide, please, that the D&O insurance marketplace, like the insurance marketplace as a whole, is cyclical. And for the years 2019 to 21, we were in a so-called hard market. The hard market attracted capital to the marketplace, and there were a host of new players that came in. And by 2022, those new markets were up and running at the same time that the bottom fell out of the IPO and SPAC market, meaning that what we had was an increase in capacity. At the same time, there was a diminution in demand. And the iron laws of supply and demand mean that pricing started to decline beginning in 2022 and continuing since then. More recently, there arguably has been some leveling, particularly in the public company D&O space, particularly at the primary level. But the question is, and if we can go to the next slide, what does that mean for 2026? And more importantly, will the D&O market move to the next phase of the cycle in 2026? And there are a chorus of observers out there, as always happens in a soft market, who are claiming that pricing has gone too far and it's gone below risk-based pricing levels. And there have been some people that have either predicted or at least questioned whether we will see a switch to from the softer phase of the cycle in 2026. From my perspective, the cause of the softer market, which is the abundant capacity, as long as it remains in place, we will remain in the soft phase of the cycle, keeping in mind the soft phases of the cycle are common and durable and long-standing, and the short phases are infrequent and short-phased. So the likelihood is that that buyers will be facing relatively favorable market conditions in the months ahead. Now, many of you observing all of these different factors affecting the D&O market are asking yourselves, how can I keep up with these things? Because so much is changing. And if you could turn to the next slide, please, Yenzel. There is a way for you to keep up, and that's by reading the D&O Diary. I have fun writing it. I hope you will read it. I try and make the content current, and I'm always looking for topic suggestions. So please drop me a note if you have any suggestions. Could you take it away and close us out now, Marissa?
Absolutely, Kevin. Thank you so much for leading this fascinating discussion this morning, as always, with our top 10 webinar. And next slide, please. And before we break off, we just want to remind everyone that we're really interested in your thoughts and reactions to this morning's webinar. So if any of you have a moment, please drop one of us a note. Our contact information is on the slide to let us know what you thought about today's session. We'd also like to thank our RT colleagues, Yanzel Daskalakis and Deirdre White, for their technical help and design input. Yanzel and Deirdre, we could not do this without you whatsoever. Thank you so much for your help on this year's webinar. And we want to thank all of you for your time this morning. We wish everyone a very successful 2026, and we look forward to the opportunity to work with all of you. Thank you and goodbye.
Thank you all.